We're in an extraordinarily complex world right now where we're seeing supply shocks that we haven't seen since possibly World War II, or certainly since the 1970s. We've just had a pandemic and everybody's scrambling to figure out what the hell is going on. Where is this going? Are we going to get a recession? The issue right now is inflation. This is the thing that everybody's talking about and everybody's fearful of. Is we've never seen inflation like this, well, not since the 1970s. So if you look at the chart of CPI now, you can see we're at levels of 8%, which is something we can't get our heads around in this apparently deflationary or disinflationary world. How did this happen? Was this the money printing? My view is that the persistent inflation of the 1970s that you can see on this chart was actually driven by demographics. When the baby boomers came into the population in the largest number in history of, let's say, 30-year-olds all buying their first house, first car, and everything else together, we had a demand shock. We also had supply shocks as well, from the Arab oil embargo in 73, 74, and then going into the Iran crisis in 79. So we had a double. We had a massive demand shock and a massive supply shock. This time around, I think it's different. This time around, we have a supply shock because essentially the pandemic had shut a lot of things down. So that was the supply shocks of trucking and moving goods around and manufacturing, and factories weren't open. And so you had to bid for higher prices to get stuff. And then there's the issue of underinvestment in commodities themselves. So what's happened is, as the world's reopened, we don't have enough ability to produce commodities at scale. Then we throw in the Russian crisis, the war in Ukraine, and we've taken commodities out of the market. It's created this very heady mix that is really scary right now for everybody. And I'm going to talk you through why I think that we are at peak inflation fears and the world is about to change towards low growth and inflation coming down, and what that might mean to you, your portfolio, the economy. Everything in financial markets is about rate of change. It's not levels. Now, the rate of change of inflation is still going up, but commodity inflation has been going down and fast for a period of time. That will feed through to CPI. So this is the all commodities year on year. But one of the things we've been talking about is food commodities. So the food commodity chart, people have been talking about global food shortages. Okay, how scary is the food situation? Could we end up with global food shortages? We're going to end up with some shortage for sure. A lot is going to depend on this harvest in the West. And also whether they use food as a weapon against Russia or not, or whether foodstuffs can continue to flow as they did even when we had the Cold War with Russia. People really don't want to create this food situation, but we've got problems with fertilizers, all sorts of stuff. But the year-on-year rate of change is coming down. And that means that CPI is going to come down. Doesn't mean your food price is going to get cheaper, but it means the rate of change becomes less shocking. The other part was the supply chain issue that created inflation. And supply chains are starting to ease everywhere. Now we have a situation in China that again makes this world bloody complicated, because we don't know how long the Chinese situation with COVID and the shutdowns are going to last, and what it actually means, whether those pictures of all the ships in the ports of Shanghai are going to create supply chain issues, or whether they're more normal. You know, again, we can't really get all of our news flow from Twitter. We need to do the homework on it. And when I look at, for example, in the US rail car loadings, you see this chart, rail car loadings year-on-year rate of change have collapsed. And so that's telling us that the supply chain issues have been resolved and we're back to some normality. In fact, significant weakness. These rail car loadings are weak enough to suggest that the ISM should be well below 50. Now, is that going to be the case? I don't know, but I'm going to show you evidence why the ISM may do that. The ISM, for those of you who don't know, is the Institute of Supply Management survey, which basically is my guide to the business cycle. It basically is a lead on GDP, or it's essentially real-time GDP. And if the ISM crosses below 50, then growth is around 1% in the US economy. Once it gets to about 47, it suggests the economy has stalled and we're close to recession. So 47 print has usually given almost 100% of the time a recession. So those are the things I'm looking out for, is growth and what growth can do to inflation. So railcar loadings, as I said, are suggesting ISM's coming lower. The other one is we had big shipment problems before. Now we've got shipments back to normal. So they're suggesting that the ISM should be back down at 50, which is basically very slow growth, which is what I think the trend rate of growth of the US economy is with an aging population and high debt. I think trend rate of growth is closer to 1% than it is to 3%, and that we're going to see that moderation inflation. And that's what freight shipments are telling you. The next chart is shipping containers. Shipping containers, you can see that spike in shipping containers before. That's when there was all of these shipping containers stacking up in Long Beach. That's all started to clear now, and we're at levels that are more normal. And in fact, we could see a rollover if demand in the US starts slowing further. So we need to keep our eye on some of these. The issue is these supply chain issues caused a behavioral change in manufacturers. What they started to do was build inventories. And inventories meant that they had goods to sell even if they couldn't get goods into the country. So everyone was forced to hold longer inventories. Now, inventories increase GDP growth. But when you draw them down, i.e. you start selling your inventories and not importing goods, is what you find is GDP growth falls. Now, if you look at the next chart of ISM inventories, these people are saying that their inventory levels are about as high as they've ever been. They've built inventories, and that was a rational thing to do. But if demand slows, then you've got an inability to sell inventory. And you can see the next chart, which is the ISM versus ISM new orders, less inventories. And here, this is leading. And this is a great indicator I've used over the years. It really works well. It's suggesting that the level of inventories is too high compared to the new orders coming through. And we're going to see inventory liquidation over time. And that is suggesting the ISM is going to come below 50. Now, it's not turned around yet. So this could be an ongoing situation. We don't know yet. Are we headed to recession or are we headed to a growth shock? My core hypothesis has been a growth shock because it's easier to forecast than the recession. But as you'll see coming forwards, there's a lot of things suggesting a recession could be on the cards. Either way, it's going to change the structure of markets and how we're thinking about things. And the key one is inflation. You see, inflation, yes, it's driven by supply issues, but inflation really is driven by demand. If you take demand out, then there's less demand for those goods fall in price. So the next chart is looking at that inventory to new orders ratio and its relationship with CPI. And what you can see is this last leg of CPI explosion, which was Russia, plus some of the existing supply shocks, while the inventories to new orders in the United States has been coming off. And it's suggesting that we could see a fast turnaround inflation. We saw something similar to this in 2008. 2008, we saw the oil price hitting $140 odd a barrel. We saw soft commodities at that time screaming higher, very similar to now. And that was driven by Chinese demand. That was a demand shock, less of a supply shock. Now, if you look back at the chart here, you can see back in 2008, we saw the same thing where inventories in new orders was falling and inflation was rising. It was resolved by inflation collapsing. And I think that is going to happen now too. If I look at ISM prices paid, so that's the prices that the manufacturers are paying for their goods, they've started to come off. Now, it's still a choppy range. It's not at concerning levels, but it's suggesting that we're going to see a moderation in CPI coming forward. So we should be around peak CPI readings right now. Whether it happens next month, the month after, I think it's kind of by June, we should start to have seen the peak and we should start to see the moderation in CPI. Okay, now the likelihood, I think, is that CPI comes lower than the market expects. And that will be driven by this demand destruction I'll come onto in a bit. And I think that is the thing that most people aren't looking at. Most people are looking at the supply equation and assuming stable demand. That's generally how most of the models work for the commodity people and the economic forecast. I look at business cycle because I find the cycle is predictable, because generally as the cycle turns and goes lower, it follows all the way through until it turns back up and goes higher. You have many times where you have the cycle gets down to almost zero growth and comes back up again, driven by fiscal stimulus. And I'll talk about that period, particularly in the 2000s, where we saw that a number of times and why that happened, because it's going to have impacts for us in this discussion today. But what I've said to people is you need to understand what higher prices does to people. If you're not raising wages, or you can't raise prices as a corporation, the high prices that you've got are demand destruction. They're a tax on consumers and businesses.
If you enjoyed this video, make sure to leave a like, comment, and subscribe. We'll see you in the next video for more finance tips and up-to-date news. Thanks for watching.